The Federal Reserve Bank came out and said that the United States economy can expect to see some long-lasting damage. So if you are investing your money, you want to make sure you understand what's going on in the economy, and that's what we're going to be going over in this video. What's up, everybody? I am Jaspreet Singh and welcome to the Minority Mindset. On May 13th, 2020, the Federal Reserve Bank Chairman Jerome Powell came out and said that the United States economy and the stock market can expect to see long-lasting damage from this pandemic. And then he said that our economy and stock market is subject to, quote, significant downside risk. That isn't very good news, especially since in April, Jerome Powell said that this recovery can be, quote, fairly quick and, quote, robust. If you ask me, the Fed sounds like a pancake. They keep flipping sides. The reason this is so concerning to investors is because the Fed's job is to kind of be like a cheerleader for the economy. And so if they're hinting at trouble, in this case it's not really hinting it, it's more like smacking us in the face with it, then that's probably not good news. From the beginning of this pandemic, we had a huge kind of like spectrum of opinions as to how things would recover, with some people saying that we would see a V-shaped recovery where we would see a very bad month or two, and then after that bad month or two, things would rebound faster than ever. Then slowly those people went away, and then we started hearing about a W-shaped recovery where things would get bad, and then things would get a little bit better, and then things would get a little bit worse again, but then things would get better really quickly. Now it looks like those people are going away, and the Fed is hinting at a question mark recovery because they're saying that they have no idea what to expect next. And to combat all this uncertainty, the Fed said, I'll just read it to you, they said that they will use all of their monetary policy tools, aka all their money printing power, until this crisis has passed and an economic recovery is well underway to support the economy. That means they'll keep the money printer running until somebody pulls the plug. And then the Fed said that Congress should also pass more stimulus measures to give people more money to help keep the economy artificially afloat. This probably leaves you wondering, okay, what does this mean for our economy and the stock market and my investments? Well, you are in the right place because that's what we're going to be talking about today. So make sure you watch this video until the end because you don't want to miss any of these key details. But before we get into that, hit that thumbs up button below because if you don't, YouTube's not going to share our video with anybody else. Subscribe to the Minority Mindset YouTube channel. That way you don't miss our new financial education videos every single week. And hit that little notification bell too, because if you don't, YouTube won't let you know when our new videos are released. Let me start by talking about the stock market, because some experts have come out and said that our stock market is more overvalued, meaning expensive, than we have seen in decades. The reason they're saying this is because the S&P's forward PE, or price to earnings ratio, is now officially above 20. What? What that means is the top 500 companies in the stock market are now on average priced at or valued at 20 times their future profit expectations. If you've ever seen Shark Tank, you might have seen somebody come on Shark Tank and say something like, okay, sharks, I have this amazing guacamole business and I got the most delicious guac you've ever tried. Last year, we made $100,000 worth of profit and I'm willing to sell you, sharks, 20% of my business for $150,000. If 20% of the company is worth $150,000, that means that 100% of the company is worth, well, $750,000. So they are selling their company for 7.5 times earnings because they made $100,000 and their company is valued at $750,000. Well, right now, the top 500 companies in the United States, the S&P 500, are selling for 20 times future earnings. Not the current earnings, how much money they've already made, but 20 times what they expect to make over the next 12 months. To put it in perspective, the last time we saw stocks valued this high based off of forward earnings was during the 2000 and 2001 dot-com bubble bursting because, well, nobody thought that these dot-com companies could fail, so people were buying them up, which made the valuations soar. So what's causing these high valuations for stocks right now? Well, a couple things. For one, companies are cutting their predictions as to how much money they expect to make over the next 12 months because of this whole pandemic. And second, the Federal Reserve Bank has pretty much given a blank check to big businesses to help prop up the market. The Federal Reserve Bank's balance sheet has hit a record $6.7 trillion because they are running their printing machine to the max. That way they can pump up the markets as much as they can. Shh, do you hear that? That's the printing machine. The second thing you want to pay attention to is what the Federal Reserve Bank and the government are doing and will be doing to help combat this economic slowdown. On May 12th, 2020, for the first time in history, the Federal Reserve Bank went out and they printed cash to go and buy corporate bond ETFs to provide liquidity into the markets. What that means is prior to this whole pandemic starting, you had these banks and institutions who had all this money, billions and billions and billions of dollars tied up into these assets, which became worthless after this pandemic started. And so they couldn't sell these assets and get any cash. And so that's when the Fed said, wait, you have packages full of crap? I'll buy these crap packages off of you for top dollar. So on May 12th, 2020, for the first time in history, the Federal Reserve Bank came to the public markets with huge piles of cash and gave it to institutions and banks in exchange for assets worth nothing. See, if you didn't know, the Fed works like fairies. They can take your crap and touch it and turn it into gold. Well, I guess they can turn it into paper dollars, not gold, but you get the point. The Fed also said on May 13th, 2020, that the longer it takes for people to stop getting sick, the longer these economic slowdowns are gonna last, and the more likely our economy and companies can run into liquidity and solvency issues. That means banks and businesses running out of money. That is not good news, because if you have liquidity issues, then the economy stops. Businesses can't access cash, they don't have money to pay their employees, and people can't go to the bank to get cash out. Liquidity issues are never a good thing. I mean, have you ever seen liquid guac? Nasty. Then Jerome Powell, the Fed chairman, said that the Fed will commit to doing everything in their power to prevent these sort of liquidity issues in our economy. Get the money printers ready! And now some politicians have proposed to send almost every American a $2,000 check every month until this whole crisis ends, which I don't know how many months that will take. This proposal is called the Monthly Economic Crisis Support Act. Not a very attractive name, but that's what it's called. And I don't know what's gonna come of it, but I'll be keeping you up to date on our YouTube channel, so if you haven't subscribed yet, make sure you do that. And then you have Dr. Fauci, who is the White House's go-to doctor for all things related to this pandemic, and he has said that we shouldn't expect this whole pandemic to stop until we have a vaccine. And then he also said that a vaccine might not be effective. You know, the one thing investors hate more than anything else is uncertainty. And if that's not uncertainty, then I don't know what is. So we have these economic issues that can't get better until the health issues get better. But we don't know what it will take for the health issues to get better or when that will be. And then we have the Federal Reserve Bank and the government printing all this money to give out to businesses and people to artificially inflate the economy. But there's a cost to printing all this free money. And that's the cost that you, taxpayers, are gonna have to pay for. And I'm not gonna go over that again in this video because I've already talked about that in a previous video. This brings me to the third prong of this puzzle, potential deflation. Deflation, unlike inflation, is when you see the price of things come down. At first, that might sound like great news because that means that your paycheck will have more buying power. You telling me I'll be able to afford more Gucci? For consumers like you and me, in the short term, deflation sounds like a good thing because we can buy more stuff because things are cheaper. But deflation is actually really bad news because deflation also means that wages come down, the value of your house comes down, and the whole economy slows down, which is not something that you want to see, especially as an investor. What you want to hear is that wages are going up and the economy is growing. Think of it this way. We are in a slowing economy right now. And let's say you own a business where you sell tape rolls like this for, let's say, $20. And in the past, you've always sold these for $20. And now, because there's no buyers out there, you are now having to lower the price of your tape to $15 a roll. Now you're making less money and you have smaller profits. So now you might have to cut some of your staff to make up for this loss. And you might have to cut the wages for other people because you're making less money. That means less people have jobs and less people have money, which means more deflation, which means more businesses might have to cut their prices. That brings the economy down. The last time we saw a prolonged deflationary period was during the Great Depression. And during that time, farmers were forced to pretty much sell their crops below cost because they had no other option. And then they didn't have enough money to make their debt payments. And so you saw this huge wave of foreclosures on farmers because they weren't making enough money. However, I should mention that right now in 2020, there is one exception to this whole deflationary thing going on right now. Groceries. the price of groceries are actually growing faster than we have seen in like 50 years. Should I buy Gucci or should I buy milk? Gucci or milk? At this point, you might be wondering, wait, the Fed has already printed so much money. Shouldn't we be seeing more inflation, not deflation? Yes and no. Yes, we will probably see these inflationary effects happen because of all this money printing, but inflation isn't something that typically happens overnight. It's a slow, gradual process. But right now, people aren't spending money for a couple reasons. Either they're scared to go out or they don't have any money, and that's forcing businesses to cut their prices just to be able to survive. That's why the Fed kind of hinted that they might print more money to make up for these deflationary measures. That way there's more money out there. That might help out today, but that could have some real long-term consequences. It's okay. My grandkids will pay for our mistakes. Remember, inflation is when you have more dollars out there. So you increase the supply of dollars, which makes the value of each individual dollar come down, which makes the price of things around you go up. And inflation is what makes the value of your savings come down, and it's what makes the value of your earnings drop slowly each time more dollars are printed. So this is really putting the Federal Reserve Bank and the government between a rock and a hard place, because if we open up the economies too fast, then we risk the resurgence of this virus and more people getting sick and more lockdowns, and then kind of like a relapse into this whole recession, which could push us into a depression. If you open the economy too slow, then we risk more businesses going bankrupt. Businesses are facing these deflationary pressures, which could push the Fed to print even more money to hike up inflation. And on top of all of that, you have a stock market that has been bailed out by the Fed and is now relying on the Fed to continually pump up the markets. So what's going to happen? Well, only time can tell, because things are changing very fast, which is why it is very important for you to stay up to date on what's happening. That way you can make the best decisions with your money. And that's why we created the free Minority Mindset newsletter, where our team first breaks down the top finance and business news, and then we show you how this news affects your wallet. That way you can be smart with your money. This newsletter is completely free, and you can join our free finance and business newsletter by clicking the link up here or by clicking the link in the description below. By the way, our financial news emails are different from our financial education emails. Thank you for watching. If you enjoyed this video, share it with one friend. That way we can help spread the word. If you want to learn more about how companies cutting dividends can actually be a good thing for you, I already made a video on it, and you can watch this video on YouTube by clicking this button right over here. Thank you for watching, and as always, keep hustling.